Welcome, everybody. Jonathan Brindley, Liquid Capital. Glad you could join us this afternoon. If you want to, I know this is kind of a strange way of doing these presentations, but if you'd like to show your face, there is a button on the top right-hand corner, I believe it says Ask to Share Audio Video. You can click on that if you so desire. Otherwise, you can, not to, whatever. Okay, so welcome. At the start of the session, I don't know if you were listening to Mark's Balash's opening remarks. He was talking about how important staffing is to the both the Canadian and the US economies. Yes, and that is very important in terms of, and also the growth in staff and the rates of employment and unemployment. But in addition to, think about any business, apart from, people, which is obviously an important thing to run your business, people and customers. Another critical part of having a successful business is ensuring that you have enough cash flow, right? And that's what we're going to be talking about today, working capital and liquidity, which is, critical to running a business. So I thought I'd start off with a quote from the great Richard Branson. Sir Richard Branson, I guess he's now. So the owner and founder of Virgin. And I think he sums it up beautifully by his quote here, never take your eyes off cash flow because it's the lifeblood of any business. And, companies that do not focus on their cash flow do so at their peril because, you can still be profitable and still go out of business. Okay. And the history is littered with numerous companies and cases where that's happened. So today, I'm going to be focusing and talking about, business in general, about how you can, the importance of cash flow and how you can deal with that and the various options available to you, both from the point of view of if you're running a staffing firm or even if you are working for a company as well. So both are important. So what are the sources typically that businesses run their business off? Well, the first one is most of us don't have one of these in our backyard, which is a money tree, unfortunately. So what is the option? Well, the first option is that a lot of people will go to the bank. And I often say, please go to the bank first. It's the best place to go to because they will tell you, they'll be able to tell you exactly how much they can give you. The problem, bank financing is great. It's the cheapest form of money out there on the street. The challenge is, there's two challenges with bank financing. Number one is you may not qualify. You've been in business for less than 2 years. You made a loss last year. We don't like your business, whatever the reason is. Or alternatively, you don't qualify for what you need. In other words, the bank says, love your business, we'll give you a $100,000 or $200,000 line of credit. Well, if you're running a $4 or $5 million business, you probably need at least $500,000 in working capital to run it effectively. So having a $200,000 or $100,000 line for the bank at prime plus a half or prime plus one doesn't really help you a heck of a lot, unfortunately. In fact, you're probably worse off because the bank's going to tie up all your assets for that small amount. The other option is what I call the love money, friends and family, which is always great to get the business going. But again, they can lead to awkward conversations around the dinner table. Assuming that we still actually meet for dinner with our families, given what's going on with the pandemic. But, when you have that conversation with, Uncle George, who says, that 100,000 I lent you, 3 years ago, when am I going to get it back? So it makes it, and it's not really scalable. The other option is companies play this game all the time. I call it opium, other people's money. What I mean by that is supplier payments, right? So in other words, they will lean on their suppliers. So instead of paying in 30 days, they'll stretch it out to 60 and 90 days. Well, that's great. And it normally works for probably the first 60, 90 days. Then your suppliers get wise to it and it strains your supplier relationship because you're using them as a bank, which they don't really appreciate. And last but not least, there's good old, let's sell a piece of the company, Dragon's Den. And the reality is, I don't know if anybody on the session today has actually had the option of trying to raise equity, but I can guarantee you it's the most expensive form of capital you will ever raise, guaranteed for your business. And I often say the best time to go looking for equity is when you don't need it, right? Because that's when, when you do need the equity, that's when you're going to have the least amount of leverage, where someone's going to say, yes, I'll give you $200,000, but I want 51% of your company. And then you've got a partner for life, which you may not want down the road. So what's the alternative? Well, there are other alternatives out there, which a lot of people and companies are not aware of. And that's what we're going to be talking about today. Given the time that I have together with you today, I won't be able to go through each of these. So I'm going to focus really on two, factoring and asset-based lending, but which are probably most relevant to what we're talking about here with staffing companies. But there's factoring, which I'll explain in a minute for you, PO financing, supply chain financing, credit insurance, and asset-based lending. So there are other alternatives there, and that's what we're going to be talking about today. So who uses alternative financing? Well, quite often they fall into different categories. You'll get established companies who've been around for a while, and they've got growth, but they have limited capital to grow that. So if you've got, I always say to people, you might be profitable and you might be making 30% margin, which is wonderful. But if you have the working capital, great, you can do it. But if you don't have the working capital, your margin on that deal is quite simple. It's zero, right? The other thing that we often see companies that use quite often this is startups, because back to my earlier comment, if you want to go for bank financing, typically you've got to be in business for at least 2 years before the bank will even look at you, which may be an issue if you've got you're trying to ramp up your business. Turnaround businesses. We're seeing a lot more of these now, given what's happening with the economy and the pandemic and everything, where companies have hit a speed bump and they have some challenges with their cash flow. Bank relationship changes. We're seeing a lot of that too these days as well, where they're getting the proverbial call from their banker saying, guess what? We're moving you to special loans. Well, for those that know about that, unfortunately, special loans is not the special that you really want from the bank, okay? So we're seeing a lot of that as well, where the companies are being either pushed out or they're being swapping out with their banking relationships. R&D companies, research and development, we do the shred financings as well available. I'm not going to go into that because it's not really relevant for what we're talking about today. And also helping people that, companies that are, got collection headaches or bad debt issues, quite often would like someone else to come in and help with the alternative financing and do that. One thing I want to sort of share with you quickly is, we're 9 months into this, or 7 months into this, sorry. What observations have I noticed here from what I call the liquid capital trenches? And the first thing is that, AR is aging out. And in other words, companies are waiting now for, stuff that they, invoices that they issued back in January, February, March, they're still waiting to get paid on. On top of that, their sales for the last couple of months have been declining, or they've been lower than normal. But at the same time, they've still got their cost to pay. They've still got, payroll to meet. They've still got rent to pay. They've still got, materials to buy if they're a manufacturing company. So it leads, long and the short of it, it leads to a liquidity crunch, which makes, liquidity even more of a challenge. The other thing that we've noticed is that, and this is, many businesses out there, this has shown how ill-prepared a lot of them are. Very few of them have what I call rainy day accounts. To use the expression, when the tide goes out, that's when you figure out who's been swimming naked. And we're seeing a lot of that situation going on right now with companies where they just don't have, the capital buffer to take them through what's going on. Again, we're seeing bankruptcy is on the rise. Again, I'm not trying to be doom and gloom here, but if you look at, for example, CCAA, which is the measure with the big companies that are registering for restructuring, I think so far this year in Canada, we've had in excess of about 53 companies, and that was up to the end of September, compared to like 38 for the whole of last year. So it gives you an idea of, how much, and that's just the big companies. That doesn't take into account the smaller companies, which are probably going through a bankruptcy or restructuring process that don't make that, get that level of scrutiny. We're seeing layoffs. I think one of the previous speakers was talking about this as well. You're seeing layoffs abound, and this is across all sectors, whether it's retailers, hospitalities, airlines, even CA firms, believe it or not, which you would expect to be at what I call the blunter end of the economy. Everyone's trying to do the new dance called the pivot, right? And some are being more successful at it than others. We are finding there's opportunities out there, and I would say the same thing for even folks that are in the staffing industry, but I think you need to tread cautiously because, creditworthiness of clients and customers is not what it was before. So the long and the short of it is cash is king. It's even more king than it was previously. So many of you probably are not familiar with factoring. So I wanted to sort of give a quick overview of how it works. It's one of the oldest forms of financing out there. It's been around since the Roman times, believe it or not. Here in North America, it's a relatively underutilized, especially in Canada, form of financing. To give you an idea, globally, it's about a $2.5 to $3 trillion business. Okay, so we're talking about, this is the value of invoices which are being factored on a global scale. In Europe, it's big. It's a big way of a lot of companies doing alternative financing. Europe does about 600 billion a year. UK alone does about 300 billion. But here in North America, interesting enough, it's not utilized as much, especially here in Canada. US does about 150 to 200 billion. Even a country like Australia does about 50 billion. Canada, we're doing about 5 to 6 billion. So it's definitely underutilized as a form of financing. And I think that due to a combination of factors, one of which is that not a lot of people are aware of it, that it's an option for them when they need to find alternative measures, alternative ways to finance their business. So hopefully, having heard the presentation today, if your company doesn't need it, hopefully you will become more aware of this. So if you come across situations with other companies, then, there's another option. So how does it work? It's quite simple. A company does, so in step one, you can say the company, has a product, either it's a product or a service, which it produces or completes, issues an invoice, and then what happens is that invoice gets issued to the customer, and instead of having to wait the 30, 60, or 90 days to get paid, they take that invoice and they assign it or sell it to a factoring company, which gives them access to that capital straight away. So those payment terms of 60 or 90 days or 30 days would have become net now, right? So typically the factoring company will advance anywhere between 75 to 95% of the value of that receivable. So if you have a $10,000 receivable, it means within 24 or 48 hours of issuing that invoice, the factoring company will give you 80% of it. I say hypothetically, that's $8,000, which gives you access to that working capital straight away, which is really critical if you think about it. I mean, as we talked about earlier, cash flow is the lifeblood of any business, so it's important that you be able to keep it's a bit like the engine oil, right? If you don't have oil in the engine, then the engine's going to freeze. So this is a way of keeping things going. And then what happens is when the money comes in from the customer, whether it's 30 or 40 or 50 days, whatever it is, the factor then processes the receipt of the payment and releases the reserve, which is the 20% or whatever reserve they've held, less any fees. So this is a great way of keeping keeping money flowing in your business. So we sort of talked hypothetically about all the sort of the high level stuff about. Now I thought I'd try and make it a bit real and talk about I'm going to talk about 2 case studies here. These are companies that we've worked with, and how we've sort of helped them with their liquidity challenges that they had. The first one I want to talk about is a company that was in the sandwich making business, which kind of unusual. This was a company that was, they had their annual sales were about $4 million. So you do the math, that's an awful lot of sandwiches, right? And they were basically selling sandwiches you might have even eaten one of their sandwiches if you'd been to a conference down at the Metro Convention Center, or you'd been at a university cafeteria. Like one of their big customers was Aramark, which runs all the university cafeterias, as well as the hotel chains and stuff like that. So you can imagine for these guys, think about it from what are the 2 biggest costs this company has? Well, one is labor, people to make the sandwiches, and number 2 is the raw materials, the bread, the cheese, the butter, the ham, etc. Now, the food they have to pay for in like 2 to 3 days, and the staff they have to pay for weekly. Yet at the same time, they were not collecting their receivables until 30, 40, 50 days out. So you can see they have a liquidity gap there of, anywhere between 20 to 30 days in terms of when they have to pay for the product, pay for the labor and the materials before they collect. So this was a challenge for this company because they were trying to grow as well. And at that time, the owner of the company, George, his name was, he was a great chef and he was great at making sandwiches and everything else. But unfortunately, he and his business partner, who was provided the capital for the business, decided to exit the business, leaving him high and dry. And he was faced with a really difficult decision as to, he didn't have the working capital, and he realized he was going to run out of cash in the space of probably 2 weeks. So he was faced with the real prospect of, do I padlock the doors? And he was employing at that time about 30 people. And do I let go the 30 people who are working for me, or what do I do? So we came in and we basically factored his receivables for the space of about 18 months and roll the clock forward 18 months. George was then able to actually sell his business. In fact, the irony is one of the companies that was, and I can't name the names because they're big company names, but one of the companies that was supplying him products ended up buying his business. So he went from a situation where he was, almost ready to shut his business down because he was running out of capital, to being able to, 18 months later, be able to sell his business and move on, which was a great. So again, it's a story which I like to tell because not many people think about that as an opportunity to be able to sort of turn the business around and then basically position it for a sale, which is important. And that was just straightforward factoring that we were doing in that situation, buying the invoices, advancing the cash, collecting the money for him, and then releasing the reserves. And again, this was a big deal because, he was generating about 200 to 300 invoices a week. So it was a lot of paperwork we had to process on this one. The next one I want to talk about is what we call asset-based lending. This is more akin to bank financing, where we're lending against pools of assets, whether it be equipment, accounts receivable, inventory. And this tends to work with bigger companies that are more sophisticated, been around for a while, and they tend to be bigger facilities. This was a company that was in the office furniture business, and they hit a bit of a speed bump in the last recession. And they needed some help, and they had a banking relationship for 25 years. A bit like my earlier slide about banking relationship changes. That's exactly what happened in this situation. And they were faced with moving to the bank special loans department. So we came in and provided the takeout financing for the bank so they could move, so they could basically transition the business. And we provided money against, receivables, and in their situation, it was inventory. And this is where we were totally in the background so typically in this situation, we have to, again, the more sophisticated clients, they'll have probably a VP finance or a controller in place. And this is where we're dealing with blocked accounts, and, the end debtors are not aware that this company is doing any other sort of outside financing. So it's very much akin to bank financing. And in this situation, this company was with us for the best part of 2 years. During that period of time, they were able to reposition their company. They also basically changed their product lines. They were able to do that and get a significant equity injection, and we're able to move on. And the lady here on the slide here is Marcia, who is the granddaughter of the original founder of the company. So this was a great story as well, where the company was able to, the granddaughter was able to move the company, further along and take it to the next chapter in its evolution. So that's sort of ABL financing, which again, as I say, or asset-based lending, as it's sometimes known for that acronym. So typically, what is an ideal client that we think would fit into? I call my sort of top 10 here. So obviously, it has to be business to business sales. They are typically running in the sales between $1 million and $50 million in annual sales. Again, we're pretty much industry agnostic. As you can see, we do everything from sandwiches to office furniture and everything in between. So, but manufacturing, transport, distribution, pretty much any product or service we can help. A critical thing for us is obviously looking at creditworthy customers who they have. And I'll be honest with you, this is becoming more and more of a challenge these days, especially with what's happening in the economy. Typically, these companies are in a situation where they need growth capital, right? Sometimes they have import-export sales going on. And it's the usual sort of good news, bad news. Good news is we got the order. Bad news is we don't have the working capital to pull it off. And often, sometimes these situations where the company needs some restructuring, or occasionally, and it does happen, the bank says no. So when your bank says no, there are, as I say, other alternatives available for you. Why would you consider a company like Liquid Capital? We've been around for 20 years. We've been doing this for a while. We're on both sides. We've got operations. We can deal with both sides of the border, Canada and US. We've deployed in excess of $3.5 billion worth of working capital throughout North America during this period of time. We believe in partnering with our clients. So you're actually dealing with a real life person like myself, as opposed to some of these algorithms. You go on these websites now and you type in your stuff and it spits back a response saying you've qualified for 50,000 or 100,000. You don't know who you're dealing with, right? So this is we believe in actually really understanding our businesses and our business owners. The other thing is that we try and make our contracts as flexible as possible, so we don't want to lock people in for long-term contracts. So the idea here is that when you need us, you can use us, and if you don't, and things change, and you want to move on, as you can see happen in both these situations with the case studies I just described, then that's fine. It's time to move on. but it does give the ability for companies to provide the liquidity for them to grow the company, as well as quite often provide them the financing bridge that they need to get them from one level to the next. So my ask is really we're out here trying to help Ontario businesses recover and grow. We do think that we're in the recovery now. It is going to be, and my perception, my view is that this is not going to be an easy recovery. And I think one of the previous speakers mentioned this as well. We're in uncharted waters. I mean, this is not where we're going to have a nice sort of V-shaped recovery and we're going to be out of this in 2 months. We could be in this for the next year, possibly 2 years. And things could get worse before they get better as we get further and further into this, which means that cash flow and liquidity issues in companies are going to become more and more critical. So, and I'm already seeing it now with the number of phone calls I'm getting with people calling and banks calling me and saying, can you help us with this client, or can you help us with that client, or even prospects coming to me and say, yes, I've just got the call from the bank, and they'd want me to exit the account. So it's happening. So as I say, if you know of any situations like that, would love to hear from you. So I mean, that's really, I don't know if we got any questions or anything.